As the COVID-19 pandemic continues to ravage the United States, the government is facing a tough decision on whether or not to shut down the country to save its struggling economy. With millions of jobs lost and businesses on the brink of collapse, it's a tricky balancing act between protecting public health and keeping the country afloat. While many experts argue that a shutdown is necessary to curb the spread of the virus, others warn that it could lead to even greater economic devastation. The country's fate hangs in the balance, and it's up to our leaders to make the right call. Investors are concerned that a potential U.S. government shutdown at the end of September could negatively impact the economy in the coming months. With the current funding for most government programs set to expire on September 30, a failure to pass a new budget by then could result in the shutdown of large parts of the government. According to strategists at Goldman Sachs, this could reduce U.S. economic growth by 0.2% each week than the shutdown lasted. This uncertainty is causing worry among investors about the economy's stability going forward. While the government has partially closed, it's a relief that essential functions such as the military and social security payments won't be affected. However, the genuine concern is the government's debt limit, which lawmakers narrowly avoided failing to increase earlier this year. The impact of past shutdowns on U.S. stocks has been worrying. CFRA Research data shows that the S&P 500 has fallen by an average of 0.4% this week before a shutdown and gained only 0.1% over the length of all shutdowns since 1976. This news is undoubtedly cause for concern. There is cause for concern as investors may react negatively to another government shutdown. The inability to pass a budget would further emphasize the political instability and lack of progress, which was a reason for Fitch's U.S. credit rating downgrade in August. This had a significant impact on the market last month. Furthermore, a shutdown could result in spending cuts that could harm the economy, especially when considering the Federal Reserve's monetary policy tightening and the resumption of payments on student loans, which are already posing a threat to growth. According to analysts, the recent surge in Treasury yields has caused some anxiety among investors, as the S&P 500, or SPX, has dropped about 4% from its July highs, while the index has yet to achieve a nearly 16% gain this year. The prospect of higher interest rates makes many uneasy about the market's future. Some Republicans in the House of Freedom caucus seems hesitant about supporting the spending bills required to fund the government for the next fiscal year. They appear to be pushing reduction in discretionary spending to $1.47 trillion, which is $120 billion less than what House Republican Speaker Kevin McCarthy and President Joe Biden has agreed upon. The Republican-led House of Representatives has only approved one of the 12 bills, with the deadline approaching. Typically, spending and tax measures begin in the House and then move to the Senate. If an unfriendly policy were to happen, a potential shutdown might mark the fourth instance in the past decade, impacting around 3 out of every 5 federal civilian workers. Although payments on Treasury bonds would continue, the resolution of previous shutdowns has varied, with some lasting only a few days. However, the shutdown in 2018 extended for 35 days, causing a reduction of 0.1% and 0.2% from actual gross domestic product in the fourth quarter of 2018 and the first quarter of 2019, respectively, as stated by the Congressional Budget Office. While Paul Christopher, head of global investment strategy for Wells Fargo Investment Institute, predicts that any shutdown could be drawn out, it is uncertain how Republicans and Democrats will position themselves for the presidential and congressional elections next year. A deal that does not increase the U.S. budget deficit could lead to higher yields on government debt and negatively impact stocks. Last month, it was announced that the White House and Congress are collaborating to develop a brief funding solution to prevent a shutdown, while discussions on long-term spending continue. According to analysts at Net David Research, a potential shutdown could contribute to the challenges that could affect the economy in the coming year. It is still being determined whether there will be enough space to breathe. So, what are the chances of the U.S. will indeed default? According to Lawrence J. White, an economics professor at New York University's Stern School of Business, no one knows because it is a political issue. I keep hoping there will be a resolution, but this is a game of chicken, and usually somebody swerves and a head-on collision is avoided. But sometimes people go over the cliff, which is the big worry, he stated. To prevent a default, the debt ceiling would need to be lifted by Congress. But Republicans Republicans are insisting on spending cuts to make it happen. President Joe Biden, a Democrat, is advocating for a straightforward vote in Congress solely focused on raising the government's debt limit. Concerns regarding the potential deadlock have recently grown due to the X date, when the Treasury may not have enough funds to pay its bills. This date has been brought forward from mid-August to as early as June 1st due to the lower tax collections in April. However, if the Treasury can manage to get by until mid-June, it will experience a surge in tax receipts from both businesses and individuals. It will also have access to approximately $150 billion in new extraordinary measures, enabling it to maintain the money flow until late this year. The United States and China are two of the largest economies in the world. Both countries have experienced impressive economic growth rates over the past few decades, making them significant players in the global market. However, despite their similarities, there are significant differences in how the two economies operate and grow. Let's compare and contrast the economic systems of the United States and China, examining their growth rates and these factors contributing to their success. By understanding the critical differences between these two economic giants, we can better understand the global economy and the forces that drive it. A complex interplay of competition and cooperation marks the relationship between China and the United States. While American leaders view China as a significant threat to their national security and economic interests, the two nations are also profoundly interconnected in many ways. Together, they account for nearly half of the global output and extensively trade essential goods and services. Additionally, they finance each other's businesses and provide a home to millions of citizens from both countries. Moreover, they collaborate on various projects, including developing popular apps and movies that appeal to audiences in both nations. Despite their differences, China and the United States remain important partners, each contributing to the global economy uniquely. According to statistics, the United States economy is still ahead of China by dollar value. In 2022, China's gross domestic product was $18 trillion, while the United States was at $25.5 trillion. But here's something interesting. China's population is more than 4 times larger than America's. So, when adjusted for local prices, the economic picture looks different. Based on purchasing power parity, China's share of world GDP is 18.9%, surpassing the United States at 15.4%, according to the International Monetary Fund. Have you heard about China's Belt and Road Initiative? It's a global infrastructure project that aims to project power worldwide. China has contributed over $1 trillion toward this initiative. However, this growth and modernization of China's military have sparked concerns in the United States. China has more naval vessels than the United States and more military personnel, with 2.5 million in 2019. Although tensions between countries have increased, their trade remains strong. China is the United States' third largest trading partner, following Canada and Mexico. Last year, the US imported goods and services from China worth a record-breaking $563.6 billion. However, the proportions of imports from China has declined, indicating that some businesses are severing ties with China. The business prospects for American companies operating in China have worsened considerably. According to the latest survey by the American Chamber of Commerce in China, 56% of US companies reported unprofitable business in 2022, with some attributing this to China's stringent COVID-19 lockdown measures. Additionally, 46% of American companies surveyed expected a further deterioration in US-China relations in 2023, while only 13% believed they would improve. China and the US have faced challenging times recently due to the impact of COVID-19 and economic recession. However, both superpowers are taking steps towards stability. Even though there may be some tension between them, they still keep an eye on each other's strategies to control inflation and boost the economy. They should be able to overcome these difficulties and emerge more robust than ever. It is clear that the United States of America needs to take drastic measures to save its economy. Shutting off specific sectors may seem extreme, but it is necessary to prevent further economic decline and ensure long-term stability. The government must work closely with businesses and individuals to ensure a smooth transition and minimize minimize the impact on those affected by these changes. It will require sacrifice and hard work, but with the right approach, the USA can become stronger and more resilient than ever. It is time to take action and make the tough decisions needed to secure a brighter future for all Americans.